Messina, your host. Always a pleasure to have you with me. 855-REAL-JOE. 855-732-5563. Always a pleasure to have you with me. Head to the website, realside.com. You can watch live, listen live, take the poll, buy my stuff. Give me your email address. But let's get right to it. I always love when this guy's on with me. He gives us so much information. David Fischer's been we've been with him a couple of years now. And seriously, when it comes to people handling your money, when it comes to people doing the right thing for you, I try to get the right people in here. I really do. David Fischer, again, like I said, you got to love the guy. If we get him working, you got to love the guy. Okay, we're going to have another roller coaster report today from David Fischer, CEO of Landmark Capital. I mean, we've been watching the markets, we've been watching what's happening out there in the financial world and where people are at. David, always a pleasure to have you with me.
You know, it is a roller coaster ride, and unfortunately, most people don't like this, and I don't care for it myself, but that's the nature of the environment, the season we're in, as a result of different factors that are influencing the highs and the lows of the marketplace.
Well, let me ask you a question. You know, somebody said it to me the other day about the news and the stories that we cover and what have you. Is this any different than it was 30 years ago? Is it just because now we're older, some of us are older, and we're paying more attention? Or is this a sign of the times and what we're looking forward to?
No, I think there's more uncertainty. Typically, when you get towards the end of a bull market, then it becomes very fractional, or these volatilities become greater. And I think what's adding to the volatility is the uncertainty of what might happen in a tariff world. But, you know, clearly we're in a bull market. Today represents a very, very historic day for stocks. Officially, we are in the longest bull market in history, 9.5 years. So that's causing some of this volatility. Because we're living on borrowed time. A typical stock market, bull market runs 7 years historically. So we're long past the norm from a time standpoint. It's showing some signs of old age. That's what volatility does. But it's not dead. And there's a lot of good news that could contribute to a higher market. There's some headwinds, though, also. And that's something that we should probably talk about today, at least.
Yeah, you know, it's, again, we didn't hit this on your series, but it's kind of like, a bull and a bear market. What the heck is a bull and a bear market? What drives them? And, you know, is this so scientific that you can actually reach back 20, 30, 40, 50 years and say, okay, here's how, here's how it plays out, and here's how it's going to continue to play out based on history?
Well, there's nothing that follows an exact pattern. Otherwise, we could just sit back, close our eyes, and have a computer do all the trading. And they've tried that before. And humans outperform computers when trading. So, but just specifically the definition of bull market, think of a bull that's raging, that's not going to give up. He's going to fight to the death. A bear is sleeping. He's slumbering. Leave him alone. He's in hibernation. Not much is happening. So we're in a bull market, but there's stages of a bull market, and we're in the latter part of the stage of a bull market. I think it is from a fourth quarter, we're definitely there. And when bull markets are in the fourth quarter, there's a lot of people come out and make, the gap between, it's going to grow to unprecipitous levels versus it's getting ready to make a big correction. The talking points on both sides become even larger. So that's just the normal environment. That's the environment we're in, and that's what, and people react to that. And plus what's going on politically and geographically, sure. It just magnifies this whole roller coaster effect. But, there's some good news. Corporations are making money, and earnings are driving the market. Also, and that's helped because of President Trump, in his wisdom, he did a tax cut, and it helped corporate earnings. He freed up regulations for businesses, which caused, flow of money, and not to be regulated significantly like it was under the Obama administration. So this is a major contributor for higher stock prices, but it doesn't mean it's going to continue forever.
Well, but wait a minute.
What has been happening with that is corporations have been buying back their stock at record levels. So that means the investors are kind of backing away from this a little bit.
What was the dust up with Tesla? I mean, Elon Musk wants to reprivatize the company or something. It went by at 1,000,000 miles an hour, but it seemed like there were a lot of stockholders, a lot of people were very angry about it. Why?
Well, Elon Musk is a very unique individial, and Tesla has not made money. And I'm being very polite here, obviously.
I know.
Tesla has not made any money, and they've had to raise billions of dollars, and so it's the stock is reaching some resistance, and it's not growing like it was before, and so they got to do something different. So they got the whole idea of corporate earnings coming out and Tesla making money. That story is long overdue for another chapter. So investors are kind of saying maybe this thing is not going to work out, and maybe they won't be able to get to market as many cars as Tesla's Elon Musk is announcing at the price point range that he is announcing, and they're just saying it's really an impossible feat in the time frame he's talking about, and so analysts are saying this thing is going to correct because it's not making any money, and Elon Musk is trying to reinvent the wheel, and so the next step is let's take the company private. So we don't have to report earnings publicly, because that's one of the criteria when you have a publicly traded company. You have to submit quarterly earnings or quarterly reports of earnings or losses. And so this is kind of a last Hail Mary to try and get the information that is not working more private on Tesla's part or Elon Musk. So that's why he's talking about trying to bring the privatizing the company and shooting for $140 of the price point range of the stock. So it's kind of, and he's also, some people say he overstepped his boundaries and broke the SEC guidelines of maybe having insider knowledge of private funding already set up before this was done, because he didn't even announce this to his board. I mean, so he's just very strange. So now he's kind of backpedaling on this, and there's a lot of uncertainty around Tesla right now.
Yeah, these little things is we're not just watching the market, but watching finances as a whole. And I see these things come by and I go, okay, so he wants to buy it back. What's the big whoop here? I don't quite understand. And then, but listen, when we come back, I know I took you all over the place, and I took you on our own little personal roller coaster ride. But when we come back, we'll get back on. Hey, that's pretty good. We'll get back on track. Get it? Never mind. Anyway, I'm Joe Messina, your host. David Fischer with me. Don't go far, guys. We got a lot more to talk about: how the economy's working out, what it means for you, and what you need to do to protect your money. We are back. I'm Joe Messina, your host. Always a pleasure to have you with me. 855-REAL-JOE, 855-732-5563. Look, hang out, learn about your money. David Fischer's with me. Always a good time when he's with us. We're back with David Fischer, CEO of Landmark Capital. I always love when he's on the show. Plain, simple English, right? We trust David. We trust David to give us the real information. It's really funny. Some of you have emailed me, and I say, look, when you hear me, somebody's on the show on a regular basis. In most cases, David's also a sponsor. I don't play any games with you guys, but I wouldn't have him as a sponsor. You've heard people come and go on this show. It's because I find out that they're not really working with clients and not doing what they should be doing, and I won't let you on as a sponsor. I won't even really, unless I'm having some fun with you, and you guys know what I mean. I won't even let you on to do an interview with you. So I appreciate David. I appreciate what he does and what he does for my listeners when they do call him. And David, always a pleasure to have you with me. I yanked you all around the park on the last one. We never really got on a roller coaster, did we?
Yeah, I'm not feel like I'm buckled in yet. So yeah, no, I'm just messing with you. We can talk about any subject you want, Joe.
I think you're, but I think we should talk about this because again, we had a couple of updates. We had a couple of days. I mean, this is partially a norm for a market, but as you said, there's also things going on that's really affecting the markets big time. I mean, let's talk about this.
There's some added headwinds that you normally do not have at the end of a bull market, and there's a handful of them, yes. And they are the Fed is raising rates, which puts pressure on markets, in stocks. The cost of business accelerates, and so that gets passed off as higher products, which means corporate earnings are lower. So it does affect the market. In fact, President Trump has been tweeting about that, and he's kind of pushing the Fed to stop raising rates, which is, something that's very unnormal that a president normally doesn't do. And the Fed's independent and not going to probably bow to what the president suggests there at all. But anyway, tariffs are putting another downward pressure on the market. It's almost like anytime there's big talk or uncertainty about tariffs, the market goes down. So there's a direct correlation there. There's some indicators in the Dow that we were peaked out in January as a market high. Investors are, questioning, will the market, breach that level, or was this a peak high and a market end? And now we're just kind of bumping our way sideways and leaning towards the downside. And that's what bull markets do. They kind of keep you in, they entice you to come back in. But that's one of the indicators we're seeing. The rest of the world, though, is definitely in a bear market. Chinese stocks are down substantially. European stocks are down 6%, while ours are up for the most part. But there's something that's created in America that's happening that's going to cause more of a bull market. There's tightening of the labor market. We're showing some slowing of the money supply injected in the economy, and that affects economics and could turn recessionary. And there's been a peak in the housing market and also a peak in bonds. So these things are bearish signs that shows us that we're in a midst of what you call a pre-recessionary environment. Ironically, the one major detriment that has grown into definitely almost another asset class is there's the world of Americans were broadened the gap between two economies. One segment has truly recovered from the Great Recession in 2008 at full unemployment, and they're seeing their wages rising. They're seeing their style of living get back to normal. Then a whole other segment continues to experience stagnating wages, being forced into part-time employment and maybe having several jobs as such, which creates a weaker access to health care. And typically, those individuals, by a poll that was done recently, have $400 or less to fall back on as we face dilemmas of higher gas prices and higher interest rates.
But people living week to week, this is nothing new. This is not like a news flash, and I always found that kind of interesting because even as a kid growing up, it was a commonality, and I really don't know how you change that. But this whole thing about you had said it earlier about all the regulations that were pulled away so companies could, and I don't want to say make more money because we do want I want companies to make money because most of the time, not all the time, we have some nasty players out there, but most of the time these companies are hiring more people on. They are
Absolutely.
growing the economy. So you can't just say, but I really find it it's almost rich when you hear people from the other side of the aisle screaming, "Hey, all it is he's giving money back to the companies." Yes, and unlike the companies you guys own, a lot of those companies are bringing more people on. Otherwise, you wouldn't have the low unemployment rate you have. Am I off?
No, you're not off at all. In fact, as we've talked many times, I'm a free market, free capitalist. I'm not for income equality. Although I will say this, that in commenting on your comments, Joe, is that the gap has become more pronounced. It's always been there. 10 years, 20 years, 30 years ago, 40 years ago, it's been a part of society. Every society on the face of the earth has this same challenge. But the gap has grown very large in the last 4 or 5 years. Specifically, it's escalated the last couple of years. And so that's because the tax cut was aimed at businesses and not individuals. And that's, been a negative on people who have already been challenged. And that's where they say, this is not fair to the small person. But those businesses are actually hiring more people and have done so. And that's clearly the case, which creates more job opportunities. So it's a dilemma we'll always face. We'll face it 10 years from now. Several presidents from now will face the same thing. It's and I think the gap's going to grow larger, not smaller, unless we get a staunch Elizabeth Warren type of Democrat in office in the near future and starts to make some major changes. But we're on the cuspice of a bear market. The articles are coming out. There's one that just came out here yesterday that says, what does the next bear market look like? And in summary, I'm not going to read the whole thing, but it's simply put, they're saying if you're facing retirement in the next 5 to 7 years, this is the time you should be taking money out of the stock market and not be fully exposed to this market, because it's going to turn bearish. It's not a matter of if, but when. And when it does, people look back and they say, I wish I would have sold at market peak. That's the human behavior in there. So they're implying, saying it is coming. Nobody knows that day, but it's sooner than you think, and other people are coming out and saying the same thing, like David Rosenberg. He's saying we're in a recession. It's much more closer than we think. Jamie Dimon is saying the same thing. So people who are very well respected, in the know, are saying this is not that far off.
Well, you're also been keeping an eye. The thing we haven't talked about in a while is the banking industry, and banks, I don't know where they are from a health standpoint. I don't know where they are in respect to the Fed and what they're doing to help the banks or not help the banks. Give us an overview.
Well, the banking industry is a much more, here's the good news, the banking industry is much more solid than it was obviously 5 years ago, because a couple things, they've been required to get more money on cash deposit from the Fed, so that's the good news, but they've also had times to get their books in order and prepare for the next downturn. So banks are much more healthier. Jamie Dimon, CEO of JP Morgan, has commented, though, he's probably the most outspoken CEO representing banks, the largest U.S. bank currently, and probably will be for some time. He's spoken about the economic environment. He's not calling for a crash, but he's saying a couple of things that resonates on the things that we've been saying, which he's been saying that the trade war and the government policies are just way out of line. He's calling for the Fed. You talked about the government, you talked about the trade war, you talked about reversal of quantitative easing and the Fed unwinding the balance sheet while they're manipulating the Treasury market. And this is all happening while the government is at the highest level of the debt structure in history, that the government can't control their spending. And so he's calling all these entities out. He has said that the 10-year Treasury note, recently he said this, he says, quote, I think rates should be 4% today. They're 2.98% right now. He said, you better be prepared to deal with higher rates, 5% or higher. It's a probability that most people think it's not going to happen. But it should be happening sooner rather than later, is what his sentiments are. And other people are saying the same types of things out there. Other economists are saying that we have to have higher rates. That's the way we're going to track.
We don't need higher rates. We'll have him explain that on the other side of the break. I'm Joe Messina, your host. This is The Real Side. Don't go far. David Fischer will still be with us on the other side. I remember nothing. I'm Joe Messina, your host. It's always a pleasure to have you with me. 855-REAL-JOE, 855-732-5563. Thanks so much for being with me. I really do appreciate the time you guys spend with us on the air, in the chat room, texting, tweeting, and being part of the conversation. As I said, David Fischer joins me, as he does every week. I really so much appreciate the insight and information that he gives us. Mark Capital, he's one of my favorites to have on the show and discuss money, because he doesn't put me to sleep. I mean, seriously, when you discuss the economy, you discuss numbers. I know some of you glaze over. We've talked about that. It's always interesting. The stuff that's the most important, the stuff that we kind of zone out the most about, not the smartest place to be. David, thanks for being with me. I always appreciate the time you spend with me.
Always my pleasure, Joe, to talk about some of my passions out there, about money, about how we can make sure we're properly protected.
Money. All right. So, the Fed made an announcement, and how does that really, well, first of all, tell people what the announcement is, and then how does that affect us?
They made a historic announcement saying they're estimating that they're going to create $769 billion in treasuries for the second half of the year. Now people are going like, so what does that mean? Well, let's put this into perspective. In early February this year, the Treasury announced it would need to borrow a total of $955 billion this year. So they just announced for the second half they're going to need $769 billion. Let's take a look at the first quarter and the second quarter. Here's what happened. In the first quarter, the Fed created $488 billion. In the second quarter, they created $75 billion. You add to that what they're thinking they're going to create in the second half, $769 billion. That brings us up to $1.33 trillion of brand new debt created just this year alone. Now, let me put this in perspective. What does that mean? Last year, they only created $519 billion. Last year was the highest creation of Treasury debt, though, in history. Now we're at $1.33 trillion projected. The Treasury's been off on their projections way to the downside. So, in other words, I think we're going to be borrowing or creating more debt than $1.33 trillion. It's going to probably be closer to $1.5 trillion, which ironically is what I said in January on your program, that they're going to be way off on their $955 billion projection. In 2016, there was $440 billion. 2015, it was under $400 billion. So this thing just keeps escalating. But if you put it on a chart, it went up like a rocket here this year, which goes exactly what I've been saying, that the debt is going to balloon if they have a tax cut. So the problem with this is it's going to create some massive economic uncertainty. We should be paying our debt down in the latter part of this bull market cycle. We're not escalating our debt beyond historic levels, and we're doing just the opposite of what you should be doing. And this is why the Fed is going to stay on course. They're going to continue to sell treasuries. They're going to continue to raise rates. And the reason being is when we move into recession, they have to have some arsenal in their gun chamber, their financial gun chamber, and that is lowering rates and creating more money to inject in the system. So they have to get their balance sheet down and they have to get rates up to normal levels so they can lower them again. And that's the yo-yo effect that we're going to see the Fed do. It's not going to happen for a couple of years, but that's where we're going on all this. But right now, rates are on the upswing, debt is on the upswing, the Fed is selling the balance sheet, and the Treasury is just way out of control because our government is spending like a drunken sailor.
This is really nothing new. You know, you and I have been doing this for a couple of years now, and you keep talking about them reining in their spending. And I don't disagree with you. I get it. You know, I'm not the financial guru. You are, and you're right. You have been on, 98.5% of the time. I think the only time I ever caught you was on my little bubble here in the area that I'm in as far as real estate goes. But the Fed has never stopped. I mean, not the Fed. The government has never stopped doing this. The chances of them cutting down or cutting back on their spending, I mean, you have a better chance of hitting the lottery without playing it, don't you?
Well, that's just like saying, hey, we're driving at 50 miles an hour towards this cliff, and the cliff's getting closer. Let's speed up. Let's drive 60 miles. Let's drive 70. Does this make the spending right? No. At some point, the cliff is going to be there, and we're going to go over the cliff. I mean, it's simple math. You cannot continue to spend your way out of debt. It will bring you into debt. This is what Greece tried to do. This is what Italy tried to do. This is what Argentina tried to do. This is what Venezuela tried to do. Yes, those are all smaller countries in third world, some of them, but it's just bigger numbers. Add a few more zeros behind the United States. And what happens during this environment to say, with the rhetoric of people's beliefs saying, we've been doing this all along, yeah, but we've never done it at the levels we've done it with the Fed raising rates and the Fed selling their balance sheet of $4.5 trillion. Those are two things that have never happened before, so it puts on a lot of pressure. Who's going to hold the dollar? And that's the question. Who is going to hold the debt? And who held this $1.6 trillion debt that was created here in the last year and a half? And that was Americans. 40% of foreign debt, U.S. debt, has been sold in the last 6 months. Russia has sold 80% of their United States Treasury bills.
Wow.
China is talking about selling more. The world is backing away from supporting our debt structure. And when that happens, We got to go internal, and Americans cannot support the spending of the government. Otherwise, we would be able to do it with lower rates, and the rates would not be going up. That's why rates are going up, to attract new money, to entice them to buy this debt. So it's pretty soon this thing is going to get out of control. It's not going to be, tomorrow, next week, or next month, but it's not going to be contained like it is right now. And there will be a time when the teeter-totter will tip the other direction. It's not meaning the sky is going to fall. It's just we're going to have a problem, financial problem. And that's where you're going to see some major changes.
Well, I look at this, again, you talk about selling these things off. If there's nobody to buy them, they're not selling them back to, and I know I'm taking you down a different road, but I think this is stuff that people need to understand. They need to understand how this affects us and affects their wallets. And, it's not like a stock. When you go sell stock, somebody has to be there to want to buy it and pick it up, and that kind of dictates the price of the stock. Is that the same thing with the Fed? I mean, with the Treasury bonds?
Well, somebody has to be a buyer of the Treasury. Otherwise, the market on Wall Street raises rates to entice buyers. And that's what's happening. It's called the 10-year yield. That's what we watch. When that goes over 3%, and it's not there yet, but it breached 3% this year, it caused stocks to go down because it creates uncertainty. So many people are saying, and one of the smartest guys in the banking system, Jamie Dimon, who has nothing to do with gold, but everything to do with what's going on with the money system, that's his expertise, he's saying that these should be around 4%, maybe even 5%. So he's saying rates are going to go up much more higher. This is going to cause a recession. He's saying that. So does he want a recession? No, but he says this is what's happening because the government's out of control in their policies. And it's just not this president on the debt. I mean, the previous president. It's happened for several presidents, but it's like bricks. You keep stacking this up, and pretty soon the foundation cannot hold all that weight, and something has to give, and the cracks start to happen. And rates will affect every American citizen because credit cards will cost more, home loans will cost more, car loans will cost more. Any unfixed loan that's not a fixed rate will cost more. Cost of businesses will go up in manufacturing because their product costs more because the company that they got their products from to manufacture their product costs more. And it's this snowball effect, and that's what causes a recession. Two things that cause recession, typically, Feds raising rates and Feds selling their debt. And those two things are happening. And this is the concern that's now coming out in financial news.
Yeah, so, again, I didn't want to drag you all over the place. But, all right, so last week you told us that, about gold, and since then it's been, straight up for 4 days in a row. Why? I mean, the simple question is why?
I called that gold was going to be at the bottom of the market. Gold did hit the bottom. There was a change in the sentiments on what you call the bears versus bulls in gold and Wall Street versus Main Street in gold. And without getting all too technical, there was a survey that came out, a very well-trusted survey that said now Wall Street has shifted being very pro-gold and very what you call bullish on gold. And there's some data, some technical data, which Wall Street follows that shows us, it's called a COT report, commitment of traders, that tells us Wall Street is putting their words where their money where their words are, and they're betting gold is going to go up now. So they were influencing gold going down for 9 years, and last week this changed. So there's been a big change in the gold market. We hit the bottom of gold. Now we're up 4 days in a row, actually 5 days, not in a row, but 5 days since the bottom. And this is the gold season. This is the time to be looking at gold. And if Jamie Dimon and all these others who are right, like Jim Rogers came out here just last week. He's a billionaire. The guy wears the funny bow ties. He said, don't sell your gold. Gold is going to go much higher. We're going to have one more little small equity run in stocks, and then you're going to see.
That's what happens when you give a money man a mic. You know what I'm saying? They know when to stop. Anyway, you can hear the rest of this in the podcast later on. I'm going to throw up there when we come back. Civil rights activists blast the UNC students for destroying a statue, says does nothing for black lives in Chicago. Go take a break. Come on back.